What's going on, guys? It's Nate with you today, and we're going to be talking about what the stock market thing is and how you can begin to invest. So to start off, what's a stock? Well, a stock is a security that a company will issue, which gives you ownership into the company. Companies will issue stocks when they have their IPO or initial public offering when they want to raise money. Initially, the company will be a private company, and then once it has these IPOs, it will become a public company where people like you and I can invest in their company. If you own a stock, that means you actually own part of the company. So if I buy an Apple stock, I can go around and tell people I own part of Apple, and they can't say anything about it because I'm telling the truth. See, I know it's not much because Apple does have 17 billion shares outstanding, which means there's 17 billion pieces of the company that people can buy. So if I have one Apple stock, this will make me 1/17th billion of an owner of Apple. See, I know that's not much. You're not going to be able to make executive decisions like what the next iPhone will look like or who to hire or who to fire, but there are many benefits in owning some of these stocks. So when stocks go up or when they go down, you're able to buy more or sell them in order to make your profit. So if I buy an Apple share at $100 and over the time Apple makes money and the stock goes up to $120, I'm able to sell that same share that I own and pocket that $20. Of course, you're going to get taxed on that, but that's a different subject. Another benefit with stocks is there's something called dividends. Companies will actually pay you, the owner of the stock, a portion of their profits. So with Apple's situation, they have a dividend percentage yield of 0.06. So this means they'll pay me 0.06 of whatever I have invested. If I have $1,000 invested, they'll pay me $6 over the course of a year just for having my money in that stock. See, I know this isn't much because it's $6 on $1,000. What is that? But it does get higher, like AT&T. AT&T actually has a dividend yield of 7%, which means they'll pay you $70 on every $1,000 that you have invested. I'm just using those numbers for easy math. Doesn't mean that you have to have $1,000 just to get a dividend. You can get a dividend on $1, 10 cents, and so on. So you may be thinking, great, I'm just gonna put all my savings in these high yields dividend stocks and gather money and just make money on my savings. Well, don't do that because these dividends do change, and there are something called dividend traps. These are companies that have dividend yields of 13, 14, and 15 or higher percentage. You're like, yeah, I'm gonna make $13. I'm gonna make my money back in 5 years just off dividends alone. The stock price is gonna go up, and I'm gonna make so much money. Well, these dividend traps are something that companies will do and then bring in their investors and lower their dividend just before the ex-dividend date. Now, this ex-dividend date is the date that you need to have the stocks in your portfolio in order to get paid. So companies will have the high yields up until that date, and then right before that date, they'll lower them just so they don't have to pay that out. So if you're looking at dividends, make sure to look at the history, the payout history on how often they pay, if they fall through with what their dividend yield is, and all that kind of stuff. So for the most part, there are two approaches that you can do while getting into the stock market. There's investing and there's trading. There's a few differences between the two. Starting off with traders. Traders are people who have short-term outlooks on the market and make trades within minutes, days, sometimes weeks. See, day trading is much more riskier than the long-term outlook of investing. Day traders use technical analysis, which does a deep dive into graphs and charts of the stock. They'll use things like support and resistance to graph out and see where their entry points and their exit points are on stocks. Technical analysis and short-term trades are influenced by things like news that comes out in the short term, by earnings, by different catalysts in the market, and sometimes even rumors. Day traders look for stocks that are very volatile or moving up and down in a short period of time. They don't want to trade things like AT&T where they're only moving 5 cents every so often and this much 1% every week, or if even that. They want to look for high moving stocks that move 10% a day, 15% a day, so they can make the most out of their money. One of the things with day trading, it's very, very expensive. Many brokerages, if not all, limit you to only 3 day trades a day. If you do exceed or hit that 3 day trades a day, you're going to be labeled as a day trader by that brokerage, which means you can only make day trades if you have $25,000 or more in your account. So the next thing that I talked about, or my personal favorite, is investing. This is something with a long-term outlook where you're just buying stocks and holding them, waiting for them to appreciate where you can eventually sell. With these, you want to buy stocks that you believe in, you've done your fundamental analysis, which I'll go over in a few, and you don't want to just buy what people are saying on Twitter or what you heard at the coffee shop. I'm not saying that people on Twitter or at the coffee shop don't know what they're talking about, but at the end of the day, these people don't care about your money as much as you do. So make sure you're doing your due diligence and research within these stocks. In order to begin investing, you want to start off mentally. You want to prepare yourself to withstand all the downs and all the ups and know that this is a long-term game. You also want to write down your goals. You want to know how much you want to make, how much you're able to invest. You don't want to just throw all your savings in there. And you also want to know how long you want to be in the market. Do you want to take your money out in 5 years, 3 years, 10 years, 20 years, 40 years? Things like that. And lastly, you want to know what kind of route you want to take. Are you younger and you're looking for something like growth, or are you older where you need another stream of income? This is where you'll look into dividends. For younger investors, you want to look for growth just because you don't want that extra taxable money that's coming in. I know it's cool and all to get that extra money every month and you feel like you're making more money, but at the end of the day, like I said, it's nothing but just another opportunity to be taxed. When I first started my long-term portfolio, I actually went with a route for dividends. I was in that psychological mindset that, yeah, I'm gonna be making money every month and I'm gonna get $300-400 a year just for having my money in the stock, and that's $30 enough to pay for my gym membership. And then I realized I'm too young for this and I'm just creating a tax burden on myself. So then I switched everything to growth ETFs, where I'm just putting in money every so often and watching that grow, where eventually I can sell those when I'm older and put them into dividend stocks, avoiding that big tax liability. When investing in the stock market, you want to make sure that you're not investing with anything that you need within the next 1, 2, or 3 years. My rule of thumb is any money that I'm putting into the stock market, I'm not touching it within the next 3 years. So now the real question, how do I know what to buy, or how do I know what makes a good stock? Well, this is where you use what's called fundamental analysis. You look at different aspects of the company. You can start off with their balance sheet. This is what shows you their assets and their liabilities, what they own and what they owe. Especially you want to especially take a look at things like debt to asset ratio. This just shows you, are they financing things with money, or are they using leverage and loans and to pay off all their assets? If the debt to asset ratio is 1, this means they have the same amount of debt as they do assets. If it's something like 0.1, this is great because this means that they have 10 times as many assets as they do debt. When the company has more debt and less assets, or more liabilities, this makes the company more risky to invest in. So that's one thing to look at. The next thing you want to look at is the income statement. This shows the revenue, or how much the company is actually making, and how much money they're bringing in. When looking at these income statements and balance sheets, you want to take a look at their growth. You don't want to have tunnel vision on one quarter or 1 year. You want to see the overall picture. In the last 5 years, has this company been moving up? Are their profits moving up? Is their growth good? Are they in an emerging sector like EV or renewables? These are all things that are going to tell you if the stock's going to grow or decline in the next coming years. The next thing you want to look at is everyone's favorite, which is PE ratio, or price to earnings ratio. This is price over earnings. And this ratio shows whether the company's stock is overvalued or undervalued. If the PE ratio is high, this means investors are willing to pay more because they see more growth in the future. If it's low, this means that investors are willing to pay less, or it's undervalued. When analyzing PE ratios, you want to make sure that you're comparing apples to apples. You want to look in the same sector. You want to compare Verizon's PE ratio to AT&T's. You don't want to compare Verizon's to Ford because that doesn't do you anything. You're looking at completely different sectors. Another thing that you'll see, especially in tech when looking at PE ratios, is you're going to see very, very high PE ratios. And I mentioned tech just because these are industries where companies are putting all their money or all their earnings back into the company, into research and development, which kind of drops their earnings and makes the PE ratio go up. When the PE ratio is higher on these tech companies, this is just expecting more growth in the future. Other things that you want to pay attention to are return on equity, profit margin, news that's coming up, and of course the overall mission and purpose of the company. You want to invest in something that you believe in, like I said, not just something that someone on Twitter or the coffee shop told you about. This will make it much easier to hold on to that company and not panic sell on those red days. Okay, so you did your research, you did your fundamental analysis, you believe in the company, now you're ready to invest. How much and when should you invest is the next question. Well, there are two approaches. You can either do lump sum investing, which is just putting all your money in at once, not caring whether it's overvalued or undervalued, and just watching the stock go up or down. Or you can do what I personally do, which is called dollar cost averaging. Dollar cost averaging is basically putting in money into the stock or ETF or security every so often, just so your highs and your lows level out to a medium. What this does is it helps reduce the emotion that you have, just because you don't care if it's too high, you don't care if it's too low, you're putting the same amount of money in there. And it also reduces the risk of timing the market or attempting to time the market. So if you're looking to time the market, here's exactly how to do it. Well, the first step to do that is you have to scroll down, you have to hit that like button, hit that subscribe button, and turn on the post notification bell. And once you do that, in order to time the market, you have to realize that you can never, ever, ever, ever
1 hour later,
ever time the market. No one knows what's going to happen in the stock market in 5 minutes, let alone 5 months or even 5 years. Don't be that person that says, I'm just going to sit out in the stock market for a few months. It's too high right now. I know it's going to drop. It's in a bubble. And once it falls, I'm just going to put all my money in there. Because trust me, you're never going to put your money in there and you're just delaying your investments. There was actually a study done on the growth of $10,000 between 1980 and 2018. If you were to try to time the market and it turns out that you missed out on just 5 of the top days, your investment from $700,000 would fall to $450,000. If you continue to try to time the market and you missed out on the top 30 days, your investment would fall to $150,000. If you missed the top 60 days, your investment would fall to $62,000. So moral of the story, moral of the study, don't try to time the market. Don't wait for those red days where you can buy super low where the market drops, because it's not going to happen. If it does happen, you've already missed on 10-20% run-ups. Time in the market is always better than timing the market. So the next thing to talk about is my personal favorite, ETFs or index funds. These are for the people that don't want to sit there and run the numbers or don't want to keep up with the news and all that stuff. What an ETF is, or an index fund, it's basically a basket. You can think about it as a Halloween basket with many different types of candies. This ETF will get portions of Apple, portions of Microsoft, portions of Google, put it all into one package and sell you it for an affordable price. This way you're diversifying, you don't have to keep up with every single company, and you're getting exposure to many different sectors or many different companies. Say you invest $1,000 into Apple and then Apple crashes. There, you just lost your $1,000. Now let's say you invest in something like VU or SPY, which is an index fund that tracks the S&P 500 and contains the top 500 American companies, and Apple crashes. That means VU or SPY, which hold Apple, will only fall a bit. It won't completely crash. So you have that diversification, which eliminates that risk, or I should say minimizes that risk. The next thing I want to talk about is penny stocks. Penny stocks is something that you should stay as far away from as possible. You don't know how many times I see people say, I just put $1,000 into this penny stock, it's at 3 cents. Dude, if it goes up to 6 cents, I'm going to be doubling my money. Yeah, you know how unlikely that is? These penny stocks are penny stocks because they're worthless and they're not established companies. I mean, has anyone watched Wolf of Wall Street? Okay, so you're ready to invest, you did all your research, you know what you're gonna buy, now it's time to open up a brokerage account. Which one should you open? Well, personally, I have 5 of them. You know, it's not one or the other. You can open up multiple brokerages accounts without any penalties. It's not like they're going to charge you. It's not going to affect your credit score. Nothing like that. Personally, I have WeBull, I have M1 Finance, TD Ameritrade, Vanguard, and one more that I'm missing. Oh yeah, Robinhood. Each of these brokerages have their disadvantages and advantages. TD Ameritrade is very good on the research side as well as WeBull. I recently had to transfer some of my stock portfolio outside of TD Ameritrade into M1 Finance. The reason for this is TD Ameritrade doesn't allow you to buy partial funds of ETFs. So you either have to buy the whole ETF or you get no ETF. So that's why I initiated a transfer to M1 Finance. M1 Finance is one that's good for long-term investors. A fair warning, it does only allow you to trade once a day, and that's at 9:30 at market open, so you have less control. But this is meant to be this way just so you're not panic selling and selling on all-time highs or all-time lows and end up screwing yourself over. The next one is Vanguard, which I don't have much experience with, but I do have my Roth IRA in there. I have my Roth IRA automatically set every 2 weeks to invest in the same stocks, so I'm not really manually doing too much in Vanguard. But this is well established, and I know many people that use Vanguard for their personal brokerages. Robinhood is the one that we all know and that many of us started with, and personally I started with Robinhood. I'm looking to move out of Robinhood to WeBull just because Robinhood doesn't have as many research tools, and it kind of is too easy to buy stocks on Robinhood. When it's too easy to buy a stock, it's also easy to panic sell. And it kind of gives you like a rush when you're up or when you're down, which is not how investing should be. Investing should be really, really boring. So if you're having too much fun investing, that means you're too emotional. So check yourself and take a break and come back when you're not as emotional. So WeBull is a brokerage account that I see many people opening up and moving into. I personally use WeBull. It has a lot of research tools that you can use. It also has something that I like, which is called paper trading. This is where it gives you fake money where you can buy real stocks. Well, you don't own the stocks, but you can trade the stocks, and it's like a stock market trading. You can say you want like $1,000, again, fake money. You can buy 100 shares or however many shares of Apple and see how that goes up and down and how your portfolio reacts, and it's a good way to learn the stock market. With that being said, if you want to open up a WeBull account and get 2 free stocks valued up to $1,600 when you deposit $100, check out the link in the description below where you can open up your WeBull account. To summarize all of that, TD Ameritrade's good, but the cons are you're not able to buy fractional ETFs. WeBull I recommend for newer investors, and M1 Finance if you're looking to invest for 10, 15, 20 years out. So with that being said, guys, thank you so much for tuning in. I really hope I helped you guys learn on how to invest and what the stock market is and what to look for. If you enjoyed the video, hit the like button, hit the post notification bell, and please subscribe, as it really does help my channel grow and push that content out there. With that being said, guys, till next time, see you guys soon.